Hello and welcome to the final session of our first Alternative Investment Week. It's been a fantastic week so far, and it's great to see so many people logging in to join us today. My name is Sally Kramers. I'm head of events here at UKSIF, and I'll just be running through a few things before we start. Firstly, a big thank you to our supporting partner, AIMA, for helping us get the word out about this event. They are the Alternative Investment Management Association. Secondly, all of the sessions this week are live and interactive. You can ask questions in the Q&A tab at the bottom of your screen to get involved in the conversation. All of the sessions will be recorded and made available to our membership as soon as possible. So without further ado, I will introduce you to our wonderful panelists and let them say a few words about themselves. We have Wayne Bishop, who's the CEO of King & Shaxson Asset Management, Freddie Cowper-Coles, who's Investment Director at Triple Point, Christine Chang, who's Deputy Chief Investment Officer at Big Society Capital and co-manager of the Schroder BSC Social Impact Trust, Fabienne Davies, Sustainability Manager at NewRiver, and Philippa Gill, Director of Europe, EVORA. Wayne, will you kick this off and say a few words about yourself?
Good morning. Yes, my name's Wayne Bishop. I am the CEO of King & Shaxson Asset Management. We are a very old name in the city. King & Shaxson's been going since 1866, but we're part of a Singaporean conglomerate. What I would sort of like to say is we've been occupying the sort of darker green impact stroke ethical investment space now for since 2002, so almost 20 years. And over that time, we've seen a lot of things change. And we're coming into this presentation and talking about property very much from a user perspective. In fact, both Freddie and Christine at Triple Point and Schroder Investment, we do use their products. And I would say that over time, and I'll come back to this probably later on in the discussion, we've seen the market change, and we are in a position, to sort of make much more impactful investments with property. When we started, the range was limited, but we now have a position where our investors want it, and I'll come back to this point later, that any property investment we make, anything we do, has a good social impact, has a positive impact, as well as being good properties to own from an environmental perspective. This is obviously a very important part of asset allocation, a very important part of what goes on in terms of running investor money, managing risk, etc. And therefore, getting it right from both an investment perspective and from an ESG stroke impact or ethical perspective is very, very important.
Perfect. Thanks very much. And Freddie, I'll hand it over to you.
Great. I don't know where I've tried turning my camera on, but I can't for some reason, Sally. I think it's been blocked. But yes, I'm Freddie Cowper-Coles. I'm an investment director at Triple Point, which is the fund manager for Triple Point Social Housing PLC. We launched our fund in 2017, raising £200 million of initial equity. And our goal was to try and tackle the housing crisis, focusing on social housing. You may or may not know, but right now there are thousands of people across the country with severe and long-term health needs who are inappropriately living in institutional care settings like care homes or hospitals. These cost the government a huge amount of money and don't provide the best outcomes for the government. The government has a policy of moving these people out of these institutional care settings into the community, but as is sadly so often the case, the government doesn't have enough money to fund it. So we launched our fund to bring private sector capital and private sector skills to help meeting this housing crisis. And in doing so, we should improve the well-being of the residents, save the government money, and generate long-term sustainable income for our investors. Right now, we've got about 400 properties in our portfolio, providing homes for about 3,000 people, and we're continuing to grow to meet the demand. So yeah, I hope that makes sense, and I can talk a bit more about that later.
Brilliant, thank you. And I know the team is currently trying to find out what's happening with the cameras, so hopefully that will be sorted soon. Christine, can you tell us a bit about yourself?
Yes, hi. So I'm Christine Chang. I'm Deputy CIO at Big Society Capital. So for those of you that don't know about Big Society Capital, we launched 10 years ago, and since we've launched, we've committed over £600 million to high impact private market investments. Alongside co-investors, we've invested over £2 billion across a number of social issues, including homelessness, mental ill health, and childhood obesity. We've looked at over 400 potential investments, carried out, there we go. Is that working now? Yes.
Yeah, perfect, thank you.
Carried out DD on over 200 and have made over 100 investments. And really, we were hearing an increasing drumbeat from investors, particularly over the last few years. And this is from a wide range of investors across wealth managers, local authority pension funds, and trusted foundations for access to the types of investments that we make. And that's why we partnered with Schroder's and launched the Schroder's BSC Social Impact Trust at the end of last year, which invests across 3 asset classes: high impact housing, debt for social enterprises, and social outcome contracts. And we're targeting a sustainable financial return alongside demonstrable social impact for vulnerable and disadvantaged people in the UK. But I think it's helpful to demonstrate why it is I do what I do every day with a story. So there's, I'd like to tell you the story about Pathelma and her teenage daughter, Charisse. They were living in a hostel. It made Charisse, a young teenage girl, feel really low. She used to cry at night. She was embarrassed to have her friends over. And it was just really challenging for them. They eventually found their way into a Real Lettings Property Fund home, which is in our portfolio. And now, and these are her words, she says, "There's so much ahead of us. I don't have to be ashamed of where I live. I'm just glad that we have a proper home. And isn't that how it should be?"
Definitely. Thanks, Christine. Fabienne, I'll pass over to you, if that's all right. If you could tell me a bit about yourself.
Thank you. A tough one to follow, but thanks for having me today, Sally, and part of the discussion. So very briefly about NewRiver, we're a listed REIT and an asset owner of about 33 shopping centres, 19 retail parks, and a pub company called Hawthorne with about 600 pubs. A bit about me, I've been at NewRiver for about 8 years. Over the last few years, I've sort of had a growing interest along with the sort of growing demand for ESG on our strategy, and formalised that last year. And NewRiver supported me to complete a training course with Cambridge University to do a business sustainability management course. So fairly newbie, so thanks for having me. But I now support our head of ESG as sustainability manager. What's quite unique about NewRiver's approach is we are convenience and community focused. So it's a value and retail portfolio, which means we are invested in over 60 different communities across the UK. And in many cases, we are the major stakeholder in that town. And that's a really big responsibility, which we take quite seriously to those localities. So we're long-term investors of those assets and communities. And alongside that, we've had a robust ESG program for the last 5 years and recently made a commitment to net zero this year. As an owner of physical buildings, our sort of key sustainability priorities are to transform these assets to achieve long-term climate resilience and contribute to the UK's 2050 commitment to long-term value for those communities and our shareholders. So that's a quick, hopefully 2 minutes.
Brilliant, thank you. And Philippa, can you tell us a bit about yourself and EVORA?
Thanks, Sally. Good morning, everyone. My name is Philippa Gill. I'm Director of Europe for EVORA Global. We are a focused real estate ESG investment advisory firm, which basically means, in translation in the real world, that we advise lots of funds on their ESG strategies, in fact, including some on this call. We sit very firmly between the investment and the buildings. So we have lots of teams working on strategies for some of the biggest property owners in the world, and also on a pan-European basis. We have over 100 focused ESG professionals now, but we do real assets. I used to say real estate, but we are branching out, and very reflective, I think, of what everyone said this morning, as the appetite for demonstrably meaningful investment increases. We are now also doing debt and infrastructure as this kind of real assets piece expands out. Bit of my background and the reason why I joined EVORA, I actually merged my business into EVORA. It's very important to me that the strategy is robust, but it actually delivers results on the end. So one could say that I'm fairly stringently anti-greenwash. And having spent too long, we'll just call it, in private equity, both putting those strategies together, but also working on the assets as an asset manager. I was at Tishman Speyer for 8 years, and before that at Blackstone, on German assets. I do understand both ends of that. It's possibly too easy to say it must all be an impact fund. You still have to make that money work. But it is possible to do both, and I very much enjoy being sat in the middle. We have engineers in the team, we have building optimization experts, and they keep us real. And when we put a strategy in place, our own colleagues are the first ones to say, well, that's not going to work, or why don't you do this? If you want to get to net zero, why don't we do this? So that's kind of what we do every day.
Brilliant. Thanks, Philippa. Freddie, do you mind if I ask what's the biggest challenge for your fund from an ESG perspective?
Sure, thanks, Sally. So the great thing about our fund, as I might talk about a bit more later, is that impact and ESG are built into its DNA. It is set up to tackle the social housing crisis. So there's a strong alignment between financial performance and social performance. I'd probably say the biggest challenge from an ESG perspective is standardization. Everyone in the social housing space measures and manages ESG and impact in different ways. The good thing is, though, that there are two initiatives afoot to try and remedy that situation. There's the sustainability reporting standards, which is trying to create standardized ESG metrics for housing associations. And then there is the recently launched Equity Impact Project to standardize impact metrics for equity investors in social housing. And we think this is a really important initiative. It's really powerful to be able to measure everyone by the same standards to drive accountability and therefore drive up standards. I would say another big challenge is environmental standards. It is the fastest moving area of ESG and impact. The technology is changing all the time. The thinking is changing all the time. Everyone is working towards net zero, but it is a gargantuan challenge and not everyone knows how to get there. So that's an area we're watching closely.
Brilliant, thanks, Freddie. And Fabienne, is it the same for your company from an ESG perspective as the challenges you see?
My response probably comes from more of my role being sustainability manager. So our physical biggest challenge is getting our 70s and 80s shopping centres to a net zero position in the next 10, 20, 30 years. So our retail units are one of our largest carbon emitters, which on the face of it, we've got 52 large assets that we need to get to net zero. That's not that straightforward. In terms of we know how to do it, and we are doing a set of net zero asset plans for one shopping centre, one retail park this year, to be able to know exactly the ins and outs of what it will take for us and the financial commitment it will take for us to get those assets to net zero. But when you actually look at it from more of an ESG perspective and how we're physically going to do it, that's thousands of units with individual contracts with individual retailers. So it's not 52 assets, it's thousands of units that will, we need to work towards getting to net zero. So that is our largest challenge. And that is why we do have a 3-step net zero target. So we're going to move to corporate emissions by 2025. Next will be our common parts of our portfolio by 2040. And then finally our occupied units and all other areas by 2050. And that just sort of, I guess, as a risk-averse REIT, it just gives us that little bit of breathing space. We hope to bring some of those dates forward, but I think it's right for us and our board and our shareholders to go for 2050 for areas that we don't know when we'll be able to get access to some of those units. And then in talking about those thousands of units, I think collaboration with retailers is probably one of our biggest challenges. And it's improving year on year, getting energy data to help get us to create more sustainable building is half the challenge, but investing in these spaces, getting access to them, having the best retailer relationships we can. Not every retailer has been on that journey, and they're not all a public company, so they're not all currently feeling the same pressures that we might be. A brilliant example of a retailer, I think, that is tackling that space in the value end of retail is Iceland. And I've been reading the Green Grocer book with mixed reviews, but they are really trying to tackle climate change, and they're not a sustainable business, and they accept that their reality is a mass market supermarket chain, but they're doing what they can, where they can, and showing they're an advocate, which, I mean, you can only respect that position. But however, whilst the MD's written a book on it, we still struggle to get energy data out of Iceland as a retailer because it's not in their leases. So you can see the challenges that lie ahead, but we are optimistic. The dynamic is changing, the pressures are coming from the right way, and they will be, increasing year on year.
Brilliant, thank you. And what are investors' biggest priorities when it comes to ESG investing? Christine, I'll probably start with you on this one.
Yeah, sure, thanks. So ESG investing is a large and growing market, as we've all sort of referenced in our introductory statement. So we at BSC are a subset of that and what we do. So on the impact management projects spectrum of impact investing, where A is avoid harm, B is benefit people and planet, and C is contribute to solutions, we're very much squarely in that C category, which is all about intentional creation of positive social impact. And in our market, the market has grown sixfold in the last 8 years to over £5 billion. And we think that has the potential to triple within the next 5 years. Investors thinking about ESG and impact care about where their investment goes. According to a Schroder's survey last year, over 3/4 of people would not invest against their personal beliefs. Ultimately, investors want to be sure that their investment is really doing what it promises and is creating impact. When we were out fundraising at the end of last year, what we were hearing from investors is that transparency is key. And we've produced an impact map, which is available on our website, that shows where the money has been invested, to what organizations, and the impact it's targeting. So extreme transparency is our motto.
Brilliant, thank you, Christine. And Wayne, does that sort of correlate to what you're seeing?
I would say so too. I think perhaps just a little bit. We made a decision 4 years ago to actually switch all of our investments into something that really had a tangible impact. And it was the arrival of funds like Freddie's way back, going back into that period of time, and then more recently Christina's, where you can now take your property asset allocation and actually have something genuine and tangible that you can say is a positive impact. So, and each one of these is a real life. So, when we're going to affordable housing, we know that there are now 3,000 homes out there that are a little bit more affordable. When we're going to social housing, we know that there is a genuine benefit. It's not just the benefit to the resident, it's the benefit to the environment because the homes tend to be better, and it's a benefit to those paying for this, which is the taxpayer by and large on social housing, for example. So that there are multiple benefits underneath. Investors have become more choosy over time. I'll come back to that bit maybe later. But we noticed that once these investments started coming out, people were saying, okay, we can understand the environmental credentials, and I don't want to underplay the environmental credentials. They are extremely important. Buildings are an extremely large contributor to greenhouse gases, to emissions, and therefore the environmental credentials of every building are extremely important. But I think there was a move by some investors to actually want to know that there was a real purpose behind that as well. So you can have social housing, you can have housing for the homeless now, you can have home, what we see in the Schroder's funds as well. You can see people genuinely want this, and of course, actually, from an investment perspective, of course, that did pay dividends over the last 12 months with the markets in a fairly rocky place. So that's where investors are at. They can actually see this, they get the information. This has gone from being perhaps a new concept 3 or 4 years ago into what is a very tangible reality now.
Perfect, thanks, Wayne. And a couple of you touched upon the sort of the tangibility of impact. And so how do you measure and manage impact in ESG real estate? Philippa, I'll start with you.
Well, currently the $1 million question, and it's really interesting because I've been in this space for anything over 10 years now. I just call some time. Feel free to borrow that phrase. Where as long as you could fill in a standardized report and send it back to your investors, they were pretty much happy with that. I think the pace of change right now, and many of the speakers have alluded to that, is unprecedented in the real estate market. We like to move at a slow snail pace in real estate. So 2 years worth of revolutionary European and forthcoming UK legislation has been a slight shock, she said in understatement. I do think this space is shifting right now. There have been accepted investment methodologies for presenting your data, and we work with a lot of those, whether that's your EPRA reporting or doing a GRESB submission on your fund. But this issue, I think, of intentionality and tangible impact is coming more and more to the front. And I'd say from our point of view, and we support over 100 very large institutional investors, as well as at the other end, some very intentional private equity investors. I think this desire to move away from, I suppose, large scale, more commoditized reporting into something that is really meaningful is definitely at the front of everyone's minds. How do they continue to comply with the larger requirements of the institutional world, whilst having something that they can really demonstrate the impact at the end? And I think that's a challenge for every firm. What we always say to everyone is there is no silver bullet and there's no cookie cutter. Every fund is different. Every impact it's trying to have is different. And I think it's very important to make sure that both the strategy and the reporting actually reflects what that fund is trying to do. A social impact logistics fund, I'm waiting for one, Christine, any moment now will be great, is not going to have the same criteria on the way in. It's not going to have the same investors. It's not going to have the same kind of debt structure as a global office fund. So I think it's very important to cut the cloth according to the individual business. And we work with some amazing people who are finding very innovative ways and very interesting ways to demonstrate that impact.
Brilliant, thank you. And Fabienne, is that similar to what you think?
Yeah, I guess we set environmental and social short, medium and long-term targets alongside our net zero pathway. They make sure they're measurable. So an example is by 2022, 100% of our waste will be diverted from landfill, currently at 99%. And we'll get building certificates for 100% of new construction and major renovation projects by 2025. So we have meaningful short-term targets, not just longer-term net zero pathway targets. And as a listed REIT, we prepare our ESG performance in accordance with the, European Real Estate Association Sustainability Best Practice Recommendation and Guidelines, which brings consistency and clarity to our metrics. We also do GRESB, CDP, FTSE Russell, which investors can use to monitor their investments. But ultimately, when you then have calls with those investors, they all have slightly different angles and slightly different questions. So really, I think them having a call with us, which we've seen growing demand, each quarter. It used to perhaps be an asset manager or developer on a specific project. Now it's the ESG team that they want to speak to and find out more about. It's impossible to satisfy all those demands with certain reports and things on our website because it's often very different and they have different criteria. And I sort of come from probably a less corporate background, so I kind of think these tools are great and they're absolutely required and necessary, but they don't lead our ESG program and they shouldn't. That comes from our company values, which has always put the long-term sustainable success of these communities at the heart of our operations.
Thank you. And Christine, is that, if we sort of look more into the social space, how do you measure impact there?
Yeah, so as an LP, as an investor into funds, what we look for is impact management and measurement that's built into the entire investment process. So are there clear impact objectives in the investment strategy? Is it about transitional accommodation for those experiencing homelessness? Is it specialist housing for particular vulnerable groups like children in care, people with learning difficulties? And how is that investment strategy addressing those needs? How is the data being collected and how is that data being used? So measuring and managing impact is not a one-off process, it's ongoing. It needs to be evidenced and where possible fed back into the process to drive portfolio management. So ultimately, we believe having a deep understanding of how you deliver impact is a source of value in both boosting performance and allowing you to have a better understanding of risks. And I think, Wayne mentioned this before in terms of the performance of the portfolio, the better performers in our portfolio have definitely evidenced that.
Perfect, thank you. And Freddie, from a fund perspective.
Yeah, well, On standardization, I mean, standardization is really important to be able to hold people to the same standards and drive up accountability and standards. But the difficulty you have is that the more sectors which those standards apply to, the more vague by definition those standards have to become. So I think one of the challenges is getting the right balance of standardization. So it's still meaningful level of the metrics still become meaningful for the people who apply them, but you've got enough people that it's a meaningful pool across which you can measure. So the way we manage and measure and manage impact in our fund is, well, firstly, as Christine said, we have metrics built into our entire investment process from the moment we start incurring costs before we get investment committee approval, when we go to our boards, during the property management process. And of course, we feed back all lessons from our property management process to our investment process so that we are continually evolving, continually iterating to make sure we're maximizing our performance. We also have 6 monthly impact audits from a third-party impact consultant to make sure we're held up to our own very high standards. And then, as I mentioned earlier, we're also signing up to sector-wide initiatives like the Equity Impact Project, making sure we are contributing to and being part of the sector-wide standards.
Thank you. And Philippa, how do we standardize quantification between organizations? And indeed, should we?
Well, without wanting to repeat everything both Freddie and Christine have said, I think a certain, this is an institutional market. So there does need to be a response at both ends, both, to Christine's story of the people actually living in those houses. I have a background in health and well-being and air quality, and some of the poverty statistics correlated with air quality issues, and therefore long-term medical requirements are one-for-one connected. So at that end, you do want to see that isn't a standardized approach. That does need to be understood and flexible and driving really the value. Otherwise, why did the investor put that fund in at the beginning? I think right when you zoom out at the other end in terms of certainly asset allocators who have hundreds of millions, if not billions of equity and investment and loans to put to work, it's a big challenge for them. They also want to see that impact, but you can't physically do that across multi-fund managers without some kind of standardization. So I think it's very important for each entity, whether that's a fund or a manager or whoever it is, to choose both ends of those that work for what they're trying to achieve. So, to Freddie's point about having externally audited, 6 monthly checks on what's actually going on at the kind of impact level. And then at the other end, choosing the right framework. We have seen a lot of conversions in frameworks. I don't think it's over yet. I do think the industry as a whole is still learning how to measure and value social impact. It's something that we certainly didn't hear about other than in very niche pockets, even 4 or 5 years ago. I think, interestingly, this was a movement that was happening aside from COVID and the pandemic, but it has definitely fueled that. And I think there's an awareness that the pandemic has shone the light on a lot of inequalities across, I won't go into it, that's a whole other webinar, but across both geographic, social and poverty structural areas of society. So again, just to repeat what I said before, I think it's very much for each individual operator to work out how do they satisfy, and actually just, this transparency thing is actually fantastic. Go and talk to the investors and say, what do you want to see? Rather than just putting a blanket reporting structure together for you, what is it that's important for you to see? And if it is consistency, then we will jump through that consistency hoop so that you can get the information. But please, to Fabienne's point, let's have a quarterly call, let's have an annual call where we actually tell you what's going on at the other end of the business. And I think that's a connection and a very positive, it's slightly painful at the moment because we're all trying to go through it. But I think that's a very positive move for the market.
Brilliant, thank you. And I know you touched upon it there, but it'd be interesting to hear how social impact priorities have changed in real estate over maybe the past 5 years. Wayne, do you mind if I pass that over to you?
Certainly. Yeah, because I think this is actually the change and the speed of change are two really important factors right now. If I go back, say, 6, 7, 8 years ago, your priority when looking at property tended to be around the environmental credentials, because that was really all you had before you got the sort of social housing, sort of rental housing and other impact investments in. You had basically one choice was health, so you can look at the health rights, for example. Another choice was old people's homes, and there were alternatives in student accommodation, but we struggled there perhaps with the sort of ESG factors behind providing student accommodation. To be perfectly honest, our kids in education, I felt being ripped off all the time, writing checks for halls, etc. So, but the other two areas, you could certainly see that there was a positive area, but that sort of changed, I would say, sort of 4 or 5 years ago, when suddenly you could suddenly invest in social housing, when you could invest in rental home. And the change there was investors could start to see that was viable, but also at the same time, there were other things, as well as all of the impact considerations that have been mentioned, because every single one of them is valid. There are perhaps a couple of qualitative elements that I think the clients want to see. And when you report back on these have always been very well received. Because at the end of the day, our clients are financial advisors, their clients are the underlying clients, and their clients are hearing about these investments. And that is that they really wanted to see what kind of economic impact it is having on the user, i.e. the tenant, stroke the government, etc. And also, if you are buying into new build projects, because actually one of our priorities was, were we displacing housing? Because housing itself is a huge economic problem in this country. The cost of housing is extremely expensive, whether you're renting a property in London, for example, or trying to buy a property in London and paying a hefty mortgage on it. And that has an economic consequence, because that is taken away from people's savings, that is taken away from people's consumption. And we know that we've had 20 years of undersupply in this area. So how was that economic impact? Because ironically, we talk about the social impact and we want to look at the social impacts things. We had an additional overlay, which was there was an economic impact. By providing more affordable housing, by speeding up the building process, which I know had a slight negative environmental impact on one side because you were speeding it up. But when somebody is buying half a housing estate for rental accommodation, that speeds up the whole building of that estate. That speeds up the supply of housing. So this is the kind of things that investors were wanting. So I go back, you know, we exited all conventional, if you like, commercial property 4 years ago on two out of three of our products. And it felt like a bold step at the time, but we found investors were suddenly very interested, and now they are extremely interested. Information is one of the biggest drivers of the ESG wholesale. And it's information not just to us as managers, not just to us as people who manage products, but actually to the consumer as well. They get information far more quickly. Gone are the days of waiting for an ESG report or an SRI report every 12 months. Now the information is out there, and they are demanding more, and they like to see this kind of positive impact. So when they start seeing it, they like it, and because it is addressing economic needs they are aware of, because most investors will have children and are aware of property prices and aware of the needs. When they start seeing those needs being addressed, when they start seeing the homeless issues actually being addressed, they feel their capital is being used for a genuinely strong purpose. And I think that has been a very strong evolution over the last 3 or 4 years. And it's not just in property, it's in other areas as well. And really, at the moment, we can only see that momentum growing and growing. You know, I mentioned earlier we're owned by an Asian conglomerate. Asia is perhaps a little bit behind on ESG, but I'm spending hours and hours and hours now speaking to Asia. It is rapidly developing over there. And, you know, we've seen people getting involved in social housing projects in Malaysia, for example. This whole area I believe, is really only at the beginning of an acceleration. And what we've seen here in the UK, and perhaps, you know, it's been going on in the US and other parts of the developed world, is actually rolling out globally very, very quickly.
Brilliant. Thanks, Wayne. Freddie, what's the business case? Is there a trade-off between financial performance and impact performance?
Good question. I think actually the belief that there's a trade-off between financial performance and impact performance is a myth. There may be in some businesses a trade-off between financial performance and impact performance, but there certainly isn't in the model which we use for our fund. In fact, it's quite the opposite. Rather than impact performance and financial performance being mutually exclusive, they are mutually reinforcing. If we invest in high quality properties, which are clean, safe, well-built, adapted for the needs of the residents, environmentally efficient, if we invest in the right areas according to identified local demand, then these properties receive referrals from the local health commissioners, which drives occupancy, which drives rental income from the local authorities and generates income, long-term sustainable income for our investors. And it is a very satisfying virtuous circle, because the more you generate an impact, the more you generate financial performance, which allows you to raise further capital, which means you can keep investing in the impact of in your impact strategy, which just keeps turning the flywheel faster and faster. So no, I don't believe there has to be a distinction between the two. If you find the right investment strategy, you can do both at the same time. In fact, when we launched our fund back in 2017, our advisors told us that we shouldn't use the explicit label of an impact fund. Back in the day, 4 years ago, it was seen as a slightly dirty word. It was seen as the ugly sibling of investment strategies. It was seen as neither true philanthropy nor true financial returns. People didn't understand that you could do both at the same time. But 4 years is a long time, and people are rapidly beginning to understand that you can do both at the same time, as I'm sure everyone on this call knows today.
Brilliant. And does anyone have anything to add to that one before I move on to the audience questions?
Just a very quick comment on the back of that. I think also what we're starting to see, which is really interesting, is focused debt and lending in this space. And it's really interesting in the sense of a lot of what we talked about today is about, you know, measuring and monitoring and driving that impact on the ownership end. So to make sure that end's done. It's interesting when you start to put debt frameworks together, everything has to be front loaded, because once that loan is signed, everything's in place. So it's quite an interesting mental shift in terms of how you put your planning together. But just to echo also what Wayne had said, we're seeing a lot of international capital wanting to invest across social metrics. And I couldn't agree more. You know, nobody mentioned the word in the hushed investment halls of an impact fund. Whereas now, and I think particularly it's interesting, you know, all eyes at EVORA are on the European Commission, which has, you know, I love the fact that an institution the size of the Commission has said, here's a new law. No, it's a law. Go and get on with it. No, it's not finished. And just move on, you know, moving on, we'll finish the rest of it. But in the meantime, we haven't got time to waste. Let's get on with it. Which kind of really explains the pace of change that's going on. But there is a social impact taxonomy promised for September. Our social impact team and our health and wellbeing team are eagerly awaiting that to see how, you know, the Commission's done some amazing work along with the teams at TCFD as to how to structure this kind of, let's call it impact funding now, and to eliminate the greenwash, which I'm sure everyone on this call hates. So it'd be really interesting to see how they tackle the social impact element of this. And I think that will be a very positive, it won't be perfect, and they're okay with that. I love the fact they're okay with that. So yeah, all eyes on September, and we'll see what happens there.
Brilliant. Thanks, Philippa. We have a good number of questions coming in from the audience. I'd like to encourage everyone to send them into the Q&A box at the bottom. First of these questions is, of those of you that are property managers, how many are having success with integrating green lease clauses to get tenants to report carbon data, etc.? Was COVID a good time to embed these clauses into lease documents? Does anyone want to start off on that?
Yeah, I don't mind having a quick go at that. Yeah, green leases, and no, COVID wasn't a good time to start doing green leases. We have our standard lease has some green elements to it. However, often retailers will want to strike those out before they sign it if it's anything above and beyond what their usual lease is. We have a green lease that we now are trying to, I think, better that into our business strategy for those assets. So I think we're starting to see that asset managers can see if it's the like of an M&S and they've got a good net zero strategy, that actually will help you get that retailer, you know, past the board and into that that shopping centre that you want to get it into, or retail park. So no, COVID has not been a good time for getting energy data or green leases. There's so many challenges that are faced with us at the moment, but I think only legislation can help us get a lot of those green leases and things like that through. There's only so much we can do. We have great relationships with our retailers, but we're going to need legislation to help get everybody on board.
Perfect, thank you. Does anyone else want to come in on that?
I would just comment that there are shades of green, and the approach we're taking is trying to develop expectations and get people to take baby steps. So our template lease has more best practices which are encouraged rather than hard requirements from our lessees, but we're strengthening our requirements all the time, but it all starts with data. So we're trying to get all the data we can and rolling out smart meters across our portfolio, which will give us the data we need to drive greater improvements in the future.
Perfect, thanks both. What is the role of carbon offsetting in sustainable infrastructure? Or is there a role?
Just very briefly, I'm happy to say that we haven't really talked about infrastructure at all today. So I think carbon offsetting more generally is a mechanism. It's still not quite developed. The bad news is there actually aren't enough carbon offsets at the moment available in the market to meet even current demand, never mind everyone moving to net zero. So there's a bit of a supply gap there. I think, and we are seeing this space evolve as well. There's a lot of mistrust and a lot of concern to make sure that your carbon offsetting payments are not ending up in a coal mine, to put an extreme example. But there are mechanisms coming, and I think it's very important that we get some form of regulation in that market to give the market security if there's going to be lots of money going into offsetting. But there's a reality. I mean, there's a reason we call it net zero, not zero. We all expect when we go into our homes or our offices or our logistics centres for the lights to be on when we can't see properly. That's just modern living. So there's a reality that at some point, once you've decarbonised any building or any infrastructure to the minimum possible, that the offset will be required for the rest. I don't think we're there yet in terms of, there are some available, but the due diligence at the moment that's required to give yourself comfort is still quite onerous. But there are, like I say, schemes coming that will provide, I suppose, a kite mark, a sense of reassurance that is being offset properly.
Perfect, thanks, Philippa. We've got another one come in that's, I think, related to my last question. So is there a trade-off in real estate between social and environmental impact and risk?
I'm happy to field that. So I would say if you take a short-term perspective, there potentially is a tension between social performance and environmental performance. If you insist on a really environmentally efficient property, that is going to cost more, which puts upward pressure on rents and capital expenditure in the short term, and it can delay the delivery of the housing. But from the long term, it is absolutely worthwhile investing in the environmental efficiency of the property, because the properties which have better environmental performance are typically better built. They have lower running costs, which is better value for money for government in the long term. And these schemes will attract greater occupancy because they're nicer to live in, and greater capital values we expect to see as valuers start taking into account the environmental efficiency of properties. So there may be a short-term delay and some slightly higher costs getting the scheme up and running, but in the long term, it is absolutely worth focusing on the environmental performance of properties.
Perfect, thanks, Freddie. And Fabienne, is that sort of similar to what you think?
Yeah, it's quite something that we sort of do mention to our investors a bit, is sometimes we're quite aware that our environmental score and our properties need work to get them closer to net zero. But the social sort of impact of our assets are, they're face-to-face, experiences for people that, are in some of the most deprived areas of the UK. So whilst there's the threat of online, I think some greener REITs or, retail warehouse units, they don't create that social fabric of communities. They're out of town, you know, big box warehouses in a way, and they don't provide that social fabric, a friendly face for somebody to go in and say hello to, rather than online shopping. And I think that often gets dismissed, or it often gets missed when they're looking at metrics in terms of, you know, what they need in their criteria to make an investment. So do quite often say, whilst we know environmentally that our assets need work, we're the best owners of those assets because we do have a plan, and long term they are going to be improved. So we have that social side, we're very good at that. And in terms of environmentally, you know, don't dismiss them just because they're not great right now. You know, you can invest in a greener portfolio, but that doesn't eradicate the problem of the ones that need investing and getting greener.
Perfect, thank you. Another question has just come in. Are there new construction methods around the corner that will reduce the carbon impact of the construction process? How do the panelists reduce the carbon impact of their builds? Does anyone have a view on that?
I think it is a tough area. That is a tough question. This is a very fast and rapidly evolving area. You know, as I said, you know, as in the previous question, the environmental impact of building is quite large, but the environmental long-term impact of a new building is significantly better. So that is where you get that short-term tension. We'll be looking at things in the area of green cement, for example. Just on the equity side, there are some sort of little investments in that zone, and I think areas around there will start to develop. And cement is obviously a very polluting or very dirty thing to make. So there are certainly ventures happening, certainly things happening at the moment. I wouldn't say we're there yet. I think we're still a long way away from it. But I do see there being rapid improvements over the next 5 to 10 years in all kinds of technologies. And I'm sure Philippa and that lot have probably got far more detail on that than I have. But we've certainly been monitoring the growth of that and think that, yeah, in say 10, 12 years' time, we might actually have a far different world in construction than we do now.
Just to follow up on that, I think to follow on from what Fabienne said, you know, 98% of building stock is already built. So building our way into a lower carbon future is possibly statistically not the greatest attempt. It was not sexy to refurbish before, but I think it's incumbent on all of us to make it sexy and to make it attractive and to demonstrate. So as a self-confessed embodied carbon geek, you know, I think valuing what's already there, and to Fabienne's point, working to improve the stock is there, we can actually move the needle much further. I think it's different when you come to social housing and particularly impact issues there. But, you know, the sooner we move away from the only thing to do is pull the old building down and rebuild it, the sooner we can have a much, much more meaningful impact. And also, I think, you know, I'm always reminded, I grew up in Yorkshire next to all the destroyed monasteries. Thank you, Henry VIII. But you see pieces of those monasteries all over the place. You know, there's an archway that's been put into the pub because people understood the value and what it took to make those individual products, and nobody would dream of not reusing something that had taken someone a whole month to dig out of the ground. The issue that we have now, and I think it comes back to this transparency, is we don't see that impact now. So stone might be mined somewhere and nobody ever sees that stone being dug out of the ground. And if we can somehow bring that transparency back in, and again, back to Freddie's point, show a whole life cycle costing. So taking the existing building, improving it enormously, which does require the investment piece, and giving it a new life for the next 50 years, we've actually started from a net positive sense in that we've already used everything that's already in there. And there are pockets of the industry doing that. Again, only because I work with the European Commission quite a lot. You know, the refurbishment wave there, the renovation wave, is really starting to drive change. And I think it's incumbent on all of us in this kind of ESG space to educate people to say, actually, new can be much more damaging to both people and the environment unless we're careful. You know, why don't we try and, to Fabienne's point, work on what we already have and not dispose of it and make it last longer.
Thanks, Philippa. That's a really interesting point. How has COVID-19 affected your funds has just come in? I know that's a very broad question, but potentially we could get a sort of two-line answer from each of you, if that's all right. Freddie, I'll start with you.
Yeah, thanks. Well, when COVID hit, like probably everyone else in the world, we were, quite surprised and shocked, and certainly trying to speak to our counterparties was a challenge. Commissioners were distracted. Our lawyers seemed to go AWOL. Our surveyors seemed to go AWOL. Care providers were distracted looking after the people they care for, and the housing providers were understandably reluctant about signing new long-term lease commitments because they weren't sure whether the schemes would get occupied and fill up quickly. But actually very soon market activity resumed, and people realized that we could still do these deals remotely. They realized there was as great, if not a greater need than ever for the type of housing we were providing. And in fact, specialized supported housing, which is the sector we invest into, was one of the first 3 sectors to have the material uncertainty clause removed by the Royal Institute of Chartered Surveyors. They recognized that rents would continue to be paid because the funding ultimately comes from government, and market activity was continuing, so valuations were supported by RICS. And so, although at a slightly slower pace, we continued to invest throughout COVID, and rental income continued to be paid. We actually received 100% of rent, not just since inception, but also throughout COVID, which is, I think, quite rare for property funds. And that's a testament to the vital social infrastructure we're investing in. Just because there's a change in economic circumstances, the government isn't about to turn the taps off for funding some of the most vulnerable people in society. So to the extent it's possible to say this, we had a relatively good COVID. We continue to invest, and income to continue to be paid, and most importantly, the residents in our properties continue to receive this high quality housing and care which they need and deserve.
Thanks, Freddie. Philippa, how has COVID-19 affected those that you work with?
Well, I don't think we've ever worked so hard. I think, like everybody, there's, exactly as Freddie said, there was this, probably for us, 2-week rabbit in the headlights moment. I was like, what just happened? But I mean, we've grown. When I joined EVORA last January, so I had about 3 weeks in the office before things started shutting down. We were 65 people. We're now heading for 110. We've opened in 2 other countries. We're supporting now global partners. I think the drivers behind that is that some of those big legislative drivers, like the European Commission, SFDR, were put in train 10 years ago. COVID was incidental to that, so I don't think that's really had an impact there. I think the other issue is that for whatever reason, and I'm sure there's people much better placed to explain, public demand for, let's call it, impact funding, or funding that has an impact and a positive impact, increased during COVID. And I think as we all navel gazed slightly and realized what is important to us in life, and saw what is and what continues to happen around us, I think the desire from the very large asset allocators to drive goods through that investment has only increased. And I think the appetite, it's a very economic shift. But what we're seeing is, whereas before a lot of this would be driven by ESG managers within organizations, I think the combination of legislation, public transparency now, reputational risk now has never been higher on ESG issues. And we've seen a lot of people, whether it's through stakeholder involvement, really start to shine spotlights on what people have been saying and doing, and sometimes when they don't exactly match. So I think there's a whole combination of forces that have really continued to drive this. But I'd certainly say from our point of view, and you can see this everywhere, but it has been surprisingly busy.
Thanks, Philippa. I'm going in the order I see you on my screen, I'm afraid. So Wayne, I'll pass it over to you.
Okay, no, I don't want to repeat what's been said, but I would say COVID has been a catalyst. The trends were in place, if you like, the changes in retail behaviour, which I think will swing back to a certain extent. I don't think the shopping centre is dead or anything like that. I think there's going to be more there, but basically it accelerated that. it accelerated the views on homelessness. You know, my daughter lives in Glasgow. She said, you know, the city centre of Glasgow, they basically put all the homeless into all the hotels. But it actually brought forward that issue, that whole social issue that had been sort of always brushed aside, conveniently brushed aside, was suddenly front and centre, and suddenly there was some action taken on it. So I think basically what it did, if you like, is it took what we saw as a 10-year trend and turned it into a 5-year trend or a 5-year story. So yes, it's accelerated everything. It has been a big positive for the business, if you like, but it's left a lot of it sort of rapidly increasing staff and running to catch back up again now. And I think it is, because it has really then embedded the market much more, and ESG much more into the mainstream than it was. I think it's actually going to sort of, it's given it a much bigger foundation to move forward in the next 4 or 5 years. But I still see the speed of the trend accelerating. It's not going to slow down because COVID is going away. I think basically demand from consumers, demands from regulators, because they do have a big part to play in this. And also when we start to have to deal with the cost of COVID, and we start having to deal with the nastier questions economically, politically, and society as well, like who's paying for all of this? I think that is actually also going to have a much larger ESG focus going forward as well. So I think it has, with generational shifts, been a massive catalyst.
Thanks, Wayne. Fabienne.
Yeah, so NewRiver's property strategy has always been focused on affordable rents and essential goods and services and convenience. So that fared fairly well in terms of what happened during COVID-19. I had a stat about 93% of our rent was collected, which after Freddie's 100%, I nearly didn't mention, but it's still pretty good in our sector, and 1 million square foot of new lettings and renewals in the period. So it wasn't all bad news, and of course there's been impacts, but I think they were kind of already undercurrents in the market. I don't think anyone denies that there's too much retail and leisure in some of our towns and cities across the UK. So it wasn't so much new news, it was kind of an undercurrent that was already going on and we're already aware of. And I think, you know, to echo what everybody said, it's helped speed up, COVID-19's helped speed up that process in a way to get more stakeholders aligned in those towns and cities, which really creates more opportunities, which is putting a positive spin on something that's really not been a positive year. But there's no denying, I think, the power of online as well is something that we get asked a lot about. But again, the way that our portfolio is positioned, it's sort of everyday goods and services. And I think it's easy for me to say, you know, the people that come into our towns and cities and our shopping centres want to see a smiley, friendly face. And that seems quite faceless when I say it now, but when you go to those assets and you visit those teams, they've been working there 10, 20, 30, 40 years. They have the same customers that have been coming in their whole lives. And, you know, it is really meaningful. It just doesn't feel very meaningful when I say it. You have to kind of go there and experience it yourself. And there is something that Kaki, the consumer data specialist, mentions, which is the halo effect, which is even with a physical store, I think people feel there's risk that everybody's moved quite a lot to online during COVID-19, but I think it's a store increase, physical store increase online sales by an average of 106% within a store's catchment area, which basically means you may have a physical store in somewhere like Bexley Heath, and if you look at the postcodes of those people ordering online, when you have a physical store there and when you don't, that uplift is about 106%. So that sales might not be going through the physical till, but they are going through that town because they have a physical store, and that's helped boost their presence. So there's still always been that online offline debate, and I think it's still going on now, but I think it's definitely something that's heightened, I mean, everybody's experience in terms of retail and physical retail during COVID-19.
Brilliant, thank you. And Christine, I'll pass over to you.
Thanks. So yes, I mean, I'll echo a lot of the points that have been made by everyone else on the, you know, all the other panelists, but we had that aha moment definitely of sort of, you know, saying we need to actually assess what's the deer in headlights, probably a better way, as Philippa said, you know, in terms of trying to understand what actually the implications were on our portfolio. I mean, and that was a very busy, it was a very, very busy few weeks when we were trying to do that. I would say we didn't design our portfolio for a pandemic, but I would say with the, you know, the characteristics of our portfolio around government-backed revenue streams, government has proven to be a good payer through the pandemic. You know, our portfolio has performed well through it. I mean, obviously, there's a much broader market, context here, social context here, that really tragically, the charities and social enterprise that we support have seen an increase in demand for the services that they provide. We've spoken about homelessness, but also domestic violence issues, mental health issues have massively increased in the period. We've all read those headlines. So, again, similarly, in terms of the sort of average person on the street has an increasing awareness of these issues. So we'll see how long that sort of lasts. To Wayne's point, we've seen cycles of these things in the past, but I do think it's good headwinds, tailwinds that we have for the impact investing sector more broadly.
Thank you very much, Christine. I'm afraid we're just out of time, but the resilience of ESG real estate through COVID feels like quite a nice way to have wrapped up this panel. Thank you all so much for this great session. It's been a great week of insightful discussions, and I'm sure we'll continue the conversation soon. Big thank you to Wayne, Freddie, Christine, Fabienne, and Philippa. Big thank you to our supporting partner, AIMA, and thank you to everyone for signing in. We will be circulating the recordings quite soon, and there'll also be a survey, so it'd be great to get your opinions, help us shape Alternative Investment Week in the future. We've got some great other events coming up, 2 exciting webinars in September, our Good Money Week in October, our AGM also in October on the 19th, and our autumn conference in November. If you'd like any more information on these, please head over to our website. Once again, thank you to my wonderful panel, and I look forward to seeing you all soon.
Thank you.
Thank you.